Tilray Brands is currently trading at $2.10, experiencing a massive intraday surge of $0.38, which translates to a staggering 22.09% gain for the day. Now, when a stock rockets up over 20% in a single trading session, the immediate impulse is to assume a monumental, company-altering event has just occurred, and that you're witnessing the start of a sustained breakout. The expectation is that the floodgates have opened, but the reality with a name like Tilray is often far more complex and tied to a regulatory environment that can giveth and taketh away in the blink of an eye. This isn't a steady performer like Apple stock, where a 5% move is major news. This is a sector defined by volatility, and today's explosive move is the perfect case study. The entire cannabis sector is lighting up based on renewed optimism that the U.S. Drug Enforcement Administration is finally moving forward with rescheduling cannabis from a Schedule I to a Schedule III substance. This single piece of news is the engine behind today's rally. The common belief is that this is the domino that needs to fall for companies like Tilray to finally flourish in the United States. And while there's truth to that, the deeper analysis suggests that investors piling in today might be pricing in a perfect outcome while ignoring the significant operational and competitive hurdles that rescheduling alone will not solve. The reality is that this regulatory shift, while positive, is not a magic wand for Tilray's underlying business. Let's dissect this 22% spike. The trading volume today is immense, orders of magnitude higher than its daily average. This isn't just a few retail investors on the Robinhood app getting excited. This is significant capital flowing into the name, indicating that larger players are making bets on this potential regulatory change. When you see volume like this, it suggests a powerful shift in sentiment. However, much of this buying is speculative. It's driven by algorithms and traders reacting to headlines, not necessarily by a sudden reassessment of Tilray's fourth-quarter earnings potential. This kind of price action is what makes names like Tilray so difficult for those who prefer a steady, hands-off approach, like one might find with Schwab Intelligent Portfolios. This is active, high-risk trading. This rally isn't isolated to Tilray alone. Its peers across the cannabis industry are seeing similar, if not equally dramatic gains. This sector-wide momentum confirms the catalyst is external and regulatory, not a sudden breakthrough in Tilray's Canadian cannabis operations or a spike in their craft beer sales. For anyone practicing self-investing, distinguishing between a company-specific event and a sector-wide tide is absolutely critical. What we are seeing is the tide lifting all boats, but it doesn't necessarily mean every boat is seaworthy for the long haul. Prior to this week, Tilray stock was languishing, continuing a long-term downtrend that has frustrated long-term holders. This context is essential. The stock is rallying from a deeply depressed base, so while a 22% gain is impressive, it represents a fraction of the value lost over the past several years. Investors using platforms like Fidelity or Interactive Brokers can easily pull up a 5-year chart and see the stark reality of this stock's history, which serves as a potent reminder that headline-driven rallies can be fleeting. The core of the bull thesis rests entirely on U.S. federal reform. Rescheduling cannabis to Schedule III would be significant for two main reasons. First, and most importantly, it would eliminate the crippling tax burden imposed by IRS Code 280E, which currently prevents plant-touching businesses from deducting standard operating expenses like rent, payroll, and marketing from their federal tax filings. This has been a massive drain on profitability for the entire industry. Removing this would instantly improve the cash flow and net income potential for any U.S. operations Tilray could establish or acquire. Second, it would open the doors to institutional investment. Many large funds and wealth management firms, like those associated with Fidelity Wealth Management, are prohibited by their charters from investing in companies involved with Schedule I substances. A change to Schedule III would remove this barrier, potentially leading to a wave of new stable capital from institutions that see the growth potential but have been legally forced to stay on the sidelines. This is the expectation, a financial and institutional green light. This is why the SoFi Invest platform might see a surge in interest for SoFi stocks and SoFi ETFs related to the cannabis sector if this change goes through. But the reality is much murkier. Rescheduling is not the same as full federal legalization. It would not create a unified interstate cannabis market in the U.S. overnight. Tilray would still have to navigate a complex patchwork of state-level regulations. Furthermore, they are currently a Canadian operator with limited non-plant-touching assets in the U.S., primarily their beverage brands. To truly capitalize, they would need to enter the U.S. market, likely through expensive acquisitions of existing multi-state operators who are already established but also carry significant debt. So while the financial landscape improves, the competitive one becomes incredibly fierce. Let's ground this in the company itself. Tilray Brands is a global cannabis and consumer packaged goods company. Its business is diversified across several segments: cannabis, primarily in Canada and for medical use in Europe; distribution through its subsidiary CC Pharma in Germany; beverage alcohol with a portfolio of craft breweries in the U.S., and wellness products. The strategy has been to build a consumer brands company that is positioned to enter the U.S. THC market as soon as it is federally permissible. This diversification was meant to provide revenue streams while waiting for U.S. reform, but the performance of these other segments has been mixed. The Canadian cannabis market is notoriously oversupplied and competitive, with relentless price compression that has squeezed margins. Their European medical cannabis operations show promise, especially with recent legislative progress in Germany, but it remains a smaller piece of the overall revenue picture. The U.S. beverage alcohol business provides a foothold and brand recognition, but it's a mature, competitive industry where growth is hard-won. This is far from the high-growth, high-margin profile of a company like Nvidia stock. Tilray's past financial reports have consistently shown a struggle to achieve sustainable profitability. While they have made progress in cutting costs and managing their balance sheet, they are not yet a consistently profitable enterprise. This is a critical piece of the puzzle that the current headline-driven euphoria overlooks. Many investors managing their own individual brokerage accounts need to look past the ticker's daily percentage change and analyze the fundamental health of the business. An investment, after all, is a stake in a business's future earnings power. Looking ahead, the future outlook for Tilray is a tale of two vastly different potential paths, a clear example of expectation versus reality. The expectation, fueled by today's rally, is that rescheduling is imminent. The EDA acts, President Biden confirms the policy shift, and the Safer Banking Act, which would grant cannabis companies access to traditional banking services, quickly follows. In this scenario, Tilray stock would likely continue to rally. The company could use its improved stock price as currency for acquisitions, finally entering the U.S. THC market in a meaningful way. Their access to capital would improve, borrowing costs would fall, and the path to profitability would become much clearer. This is the scenario every bull is betting on. They see Tilray as a primary vehicle for online investing in the future of U.S. cannabis. But the reality is much slower and more frustrating. Regulatory and bureaucratic processes in Washington are notoriously slow. The rescheduling could be delayed by legal challenges or political maneuvering. Even if it happens, the timeline for Tilray to translate that policy change into actual profitable U.S. operations could be years, not months. In the meantime, they still have to manage their existing businesses, which face their own set of challenges. There's also the risk that the market has gotten ahead of itself. If there is any sign of a delay or a snag in the rescheduling process, the speculative capital that flowed in so quickly today could flow out just as fast, leading to a sharp correction. This is the inherent risk of investing in politically sensitive sectors. The investment help that most advisors would give is to be aware of the binary nature of such an investment. Do you think the U.S. government will finalize the rescheduling of cannabis before the end of this year? Comment your thoughts below. The risk for those using an interactive broker's account to trade Tilray is that the volatility can wipe out gains in an instant if the political winds shift. In conclusion, the 22% explosion in Tilray's stock price is a clear reflection of the market's enormous expectation for U.S. cannabis reform. The potential for DEA rescheduling is undeniably a positive development that could fundamentally alter the financial viability of the entire sector. However, the reality is that Tilray Brands remains a company with significant underlying challenges. Its core Canadian cannabis business is in a tough market, its profitability is inconsistent, and its path into the lucrative U.S. market is still dependent on a regulatory process that is far from complete and fraught with potential delays. Even with rescheduling, the company faces a massive competitive battleground against entrenched U.S. operators. The exuberance of today is pricing in a best-case scenario, where regulatory change seamlessly translates into corporate profit. The disconnect between this expectation and the complex reality of execution